Are we looking at a falling trend, a flashing sell signal, or, I mean, a strong buy that some are still calling deeply undervalued?
That is exactly the debate right now.
Right. So, whenever a stock chart looks like a roller coaster that just completely lost its brakes, you really have to stop and ask what is actually happening beneath the hood.
Oh, absolutely.
Today, we are taking a massive deep dive into a company that is just dominating the financial chatter right now, which is SoundHound AI. The ticker is SOUN on the NASDAQ.
Yeah, and we're going to look at the raw tape, the underlying accounting, and that really intense tug of war happening between Wall Street analysts and short sellers.
But before we unpack this, if you are finding value in this deep dive, make sure to like the video, subscribe to our YouTube channel, and it is absolutely compulsory that you leave us a comment with your feedback. I mean, we really want to know what you think.
And just to set the ground rules here, remember that we are analyzing the data and sources provided to us today, April 15, 2026. This is an ongoing situation. So this is a natural debate of the facts. It's not financial advice. We're just here to spot the patterns and help you understand the mechanics driving these moves.
Okay, let's unpack this. Because we really need to start with the immediate, right now vibe of the stock before we try to decipher the business itself.
Yeah, the chart is wild.
The sheer price action on SoundHound AI is giving me whiplash. Let's look at the latest closing price. It closed at $7.85, and in after-hours trading, it was already creeping up to like $7.98.
Right.
But to really understand that price, you have to look at the 52-week range. I mean, this stock has been as low as $5.83 and as dizzyingly high as $22.17.
That is a massive swing for any asset.
It's huge, and we saw a massive 12.63% jump in just this most recent session, trading on a volume of 41.4 million shares.
Which is 60% above the average.
Exactly. So I'm struggling to reconcile this. We know someone is trading this heavily given the 41 million shares, but who is buying and selling right now? Are we just seeing momentum algorithms blindly chasing a 12% jump, or is there an actual fundamental floor being built here?
Well, it's significantly more predatory than algorithms just blindly chasing a green candle.
Really?
Yeah. I mean, you don't get 41 million shares changing hands purely on retail traders tapping buttons on their phones.
True.
That is heavy institutional volume mixed with algorithmic trading, and they are colliding right at a critical technical juncture.
Okay, break that down for me.
So the stock recently tested the $7 support level. Because it didn't crash through that floor and instead bounced up over 12%, the short-term trend is flashing a really strong bullish signal.
Right.
The algorithms aren't just buying the bounce. They're actually hunting for the stop losses of the short sellers who were betting it would drop to $6 or $5.
Oh, wow. So they see a technical failure to break lower and
They reverse direction to force the shorts out.
Yeah.
Exactly.
That explains the volume for sure, but is that kind of momentum actually sustainable?
That is the multi-million-dollar question right there. To answer it, we have to look at the Relative Strength Index, or the RSI.
The momentum indicator.
Right. Think of the RSI like a car's tachometer. It tells us if the stock's engine is redlining because buyers are euphoric and the stock is overbought, or if it's stalling out because it's oversold.
Where is it sitting now?
Well, right now, even after a 12% jump, the needle is surprisingly sitting in neutral to slightly overbought territory. It hasn't redlined yet.
Okay, so it still has some room to run.
Potentially, yeah.
Yeah.
If this engineered momentum holds and it breaks through the $8 psychological barrier, the next technical ceiling, the resistance level, is at $9.
Gotcha.
But we have to factor in the weekly volatility, which is currently sitting at 11%.
Wait, 11% week over week? That is a violent swing.
Oh, it's massive. It places SoundHound AI in the top 25% of the most volatile U.S. stocks. So for anyone watching this, you need to understand the environment here.
It's not a safe, boring dividend stock.
No, this isn't a smooth ride at all. It's a battleground. Bulls and bears are violently disagreeing on what this company is actually worth on a day-to-day basis.
Well, those algorithms might be chasing the 12% jump, but, algorithms don't care if a company can actually pay its rent.
Very true.
If we step away from the trading screens and look at their actual bank accounts, the picture gets a lot more complicated. Let's open the books and do a financial deep dive.
Let's do it.
So, SoundHound reported their full fiscal year 2025 results back in February of 2026. Total revenue came in at $168.92 million, which is a staggering 99% year-over-year increase.
Yeah, they basically doubled their revenue in 12 months.
Doubled it. That's insane.
And doubling top-line revenue at that scale, that is the primary fuel for the bullish narrative we were just talking about.
Right.
In the enterprise AI software space, Growing by 99% means your sales team isn't just winning contracts, they're actively displacing legacy systems.
But, revenue is just the money coming in the door. The real story about a company's health is always found in the margins and the cash flow.
Absolutely.
And this is where I start scratching my head. Let's talk about the margins. Their non-GAAP gross margin is holding stable at 58.0%. That sounds like a really healthy, profitable software business.
It does.
But then you look at the GAAP gross margin, the strict, generally accepted accounting principles that strip away the creative corporate math.
Right, the actual numbers.
Yeah, that number actually slipped by 6.5%, bringing it down to 42.4%. Why is there such a massive divergence between those two?
What's fascinating here is how that gap exposes the hidden cost of running an AI company in 2026.
Okay.
That divergence between GAAP and non-GAAP usually points to things like stock-based compensation and restructuring costs.
So paying their employees.
Exactly. Let's look at the mechanism. To build top-tier AI, you have to hire elite engineers away from Google, OpenAI, and Meta.
And they aren't cheap.
No, and you can't just pay them in cash. You have to offer massive stock packages.
Oh, I see. Non-GAAP ignores those stock payouts.
No.
So it shows you that the core product itself is profitable to deliver at 58%. But GAAP forces you to acknowledge that paying your talent in company stock is a real expense.
Because it is.
Exactly. That talent acquisition is what drags the actual corporate margin down to 42.4%.
So what does this all mean for the bottom line? Because when we look at the actual losses, GAAP net loss was negative $14.01 million.
Right.
Now, that is technically a 96% improvement year over year, which is undeniably huge.
It's massive progress.
But their adjusted EBITDA earnings before interest, taxes, depreciation, and amortization is negative $58.45 million.
Yep.
And their trailing 12-month levered free cash flow is still negative $18.35 million.
Yep.
Wait, I have to stop you here because I'm looking at this and it seems completely contradictory.
Yeah.
They doubled their revenue, they brought in $168 million, but they're still bleeding $18 million in negative free cash flow.
Yeah, they are.
It sounds like someone making a massive executive salary who somehow still maxes out their credit cards every single month. Well, if we connect this to the bigger picture, you have to understand the operating model of hypergrowth technology right now.
Okay, how does that excuse the cash burn?
In the AI sector today, you are engaged in an absolute land grab. You aren't trying to save pennies on the dollar to show a tiny profit today.
You want a market share.
Exactly. You are actively spending more than you make to acquire enterprise customers and lock them into your ecosystem before your competitors even get a meeting.
Right.
The only reason a company can bleed $18 million in free cash flow without sending the market into a total panic is their safety net.
Ah, the balance sheet.
That is the anchor. SoundHound is sitting on a massive cash pile of $248.49 million.
$250 million.
Yeah, and perhaps even more importantly, their total debt is almost non-existent.
Wait, really? How much debt do they have?
It's just $4.36 million, which equates to a debt-to-equity ratio of 0.94%. They are functionally debt-free.
Okay, that context entirely shifts how I view that $18 million loss.
All right.
Because if you have $250 million in the bank and you owe the banks essentially nothing, losing $18 million a year to capture market share isn't an existential crisis. It's a calculated investment strategy.
Exactly. It gives them a massive runway. They can easily afford to fund these ongoing operational losses while they chase their massive 2026 revenue guidance.
Which is projected to be, what, like over $200 million?
Yeah, management projects, it will land between $225 million and $260 million. They are burning cash to dig a moat around their technology.
But okay, if the company is growing at 99% and they have a massive cash runway and they are functionally debt-free, why is the stock price only sitting at $7.85?
That is the big disconnect.
Why isn't it trading at $30 or $40? Let's talk valuation because there is a serious debate here.
Oh, absolutely.
The analyst community is incredibly bullish. The consensus rating right now is a strong buy, and it currently holds a Zacks rank of #1.
Which is a crucial metric to define, by the way. A Zacks rank of 1 isn't just a static snapshot of the company. It's a momentum indicator focused on earnings estimate revisions.
So they are upgrading their outlooks.
Right.
Yeah.
It means that the analysts covering SoundHound aren't just bullish in general. They are actively rewriting their financial models to project higher future earnings than they were projecting a month ago.
And you can really see that in their price targets. The average target from these analysts is $14.62.
Yep.
That implies an 86% upside from where it's trading right now, with some setting a high target of $20.
Which is a huge jump.
But then you look at the actual valuation metrics. SoundHound is trading at 30 times forward sales and 14.24 times trailing 12-month price to sales.
Right.
Meaning investors are paying over $14 for every single dollar the company brought in last year. But the industry average price to sales ratio is only 13.4.
Yeah, so mathematically.
Technically speaking, SOUN is overvalued compared to its peers.
It is.
So which is it? I want to push back on this Wall Street optimism. Are listeners looking at a fundamentally undervalued AI play with an 86% upside, or is this a classic value trap dressed up in tech buzzwords?
Well, this raises an important question about how the market values the future versus how it values the present.
Okay.
Traditional valuation metrics, like the price-to-sales ratio, are anchored in what the company has already done.
Right, the trailing 12 months.
Yeah. When a company trades at 14 times its sales compared to an industry average of 13, a traditional value investor would look at that and absolutely call it a value trap. They'd say it's a stock that sounds revolutionary, but is already priced to perfection based on current fundamentals.
But the analysts projecting a $20 price target clearly aren't traditional value investors.
Far from it. In hypergrowth tech, traditional metrics often completely conflict with analyst price targets. A strong buy rating with an 86% upside is a bet on market dominance 3 years from now, not current profitability.
They are looking at the trajectory.
Exactly. The analysts are looking at that 99% revenue growth and projecting it outward. They are arguing that if SoundHound hits that $260 million revenue target in 2026, today's 7.85 cent price is going to look like a historic bargain.
They aren't buying the current sales, they are buying the future size of the company.
Yes.
Okay, so since the valuation is totally split between this massive projected upside and currently overvalued metrics, let's lay the cards on the table. We need to look at the actual business driving this. Let's outline the best case and worst case scenarios.
The bull versus the bear case.
Exactly. Let's start with the bulls. The entire best case recovery scenario relies heavily on a term that is dominating their corporate literature right now: Agentic AI.
Ah, yes. This is perhaps the most crucial distinction in the 2026 AI landscape. The market has moved way past generative AI that just writes poetry or summarizes emails.
Right, and Aragon Research just named SoundHound a leader in the Aragon Research Globe for Agent Platforms for 2026.
Which is a huge validation.
It is. This isn't just about a chatbot answering a FAQ page. Agentic AI means the software actually takes autonomous action.
Right. It does the work.
And they aren't just talking about it, they're scaling this volume through massive real-world partnerships. Let's look at what they're actually doing. They just inked a strategic deal with Associated Carrier Group in the telecom space.
Yeah.
We all know the friction of calling a telecom company, right? The endless hold times, the terrible automated menus.
That's the worst.
But SoundHound's AI agent can route those complex telecom issues, troubleshoot outages, and even process upgrades without a human.
And you really have to consider the margin impact for the client there.
How so?
If SoundHound can automate 40% of a telecom company's call center volume, the cost savings for that telecom company are astronomical.
Oh, of course.
And that makes SoundHound's software extremely sticky. Once it's integrated into the enterprise system, it's very hard to rip out.
And they're doing the exact same thing in the insurance space with Qualitas. Imagine a driver gets into a fender bender. Instead of waiting on hold for a claims adjuster, they speak to an AI agent that instantly validates their policy, handles the claim, and schedules a tow truck completely autonomously.
That's the vision.
You combine that real-world enterprise adoption with their impeccable financial health regarding debt, and the bull case essentially argues that SoundHound is going to become the invisible, default voice automation infrastructure for massive legacy industries.
Right. And if they become that default infrastructure, like the AWS of voice automation, that $14 or $20 price target suddenly seems entirely reasonable.
It really does.
That is the bull case. They win the enterprise market, the revenue keeps doubling, and the $248 million cash pile sustains them until they finally flip the switch to profitability.
But we have to look at the bear case.
We do.
The worst case continuation lower because the risks for the average investor are profound here.
Definitely. And the bears point right back to what we discussed earlier, the profitability lag.
Right. Despite that incredible revenue growth, they are still reporting those GAAP net losses and negative cash flow.
Yeah, but there is a massive hidden risk here that the bears are howling about, and it's share dilution.
Oh, this is so important. This is a mechanism that is critical for anyone holding the stock to understand because it silently erodes your wealth.
It really does. Let's look at the numbers.
Okay. In 2024, SoundHound's total share count was 393 million. By 2025, that count had jumped to 422 million shares.
Wow.
They added almost 30 million new shares to the open market in a single year.
And this connects perfectly back to our earlier discussion about their GAAP versus non-GAAP margins and stock-based compensation.
Paying the engineers.
Exactly. When a company issues millions of shares to pay its engineers or to raise capital to fund that negative free cash flow, it actively dilutes the ownership percentage of every single existing shareholder.
It's just watering down the stock.
Share dilution in a hyper-growth company is like printing more tickets to a concert that is already sold out. The band is making more money, the stadium is packed, but now you have to share your seat with 3 other people.
Right.
The pie got bigger, but your individual ticket just lost its value. Even if the company grows its revenue, the value of your individual share is being actively suppressed by this constant dilution.
Here's where it gets really interesting, because when you combine that ongoing share dilution with the next metric, you get a recipe for absolute market chaos. Let's talk about the short interest.
Oh boy.
Right now, short interest on SoundHound AI is exceptionally high. 32% of the float, meaning 32% of all the shares available for public trading, are currently sold short.
That is massive.
Institutional investors are actively betting billions of dollars that this stock is going to crash. I want to pause here because this is where a lot of retail investors get hurt.
Yeah, they do.
Can you explain the actual mechanics of a short squeeze, and explicitly, why do retail traders often get trapped in these exact situations?
It is one of the most dangerous dynamics in the modern stock market.
Yeah.
Let's break down the mechanics.
Yep.
When a hedge fund shorts a stock, they're essentially borrowing shares from a broker and selling them into the market at today's price.
Hoping it goes down.
Right. Their goal is for the price to drop so they can buy those shares back much cheaper next week, return the borrowed shares to the broker, and pocket the difference as profit. But if the stock price starts going up, say, jumping 12% in a single session like we just saw with SoundHound, those short sellers start losing money incredibly fast.
Because there is mathematically no ceiling on how high a stock price can go.
Exactly.
If you short a stock at $7 and it goes to $70, your potential losses are infinite.
Precisely the danger. And if the price goes high enough, the hedge fund's broker will issue a margin call. The broker essentially says, hey, this trade is too risky now, you have to close it.
And to close it.
To close the trade, the short seller is forced to buy back the shares at whatever the current market price happens to be.
Which creates massive artificial buying pressure.
Yes. You have regular retail buyers buying because the stock chart is turning green, and you have institutional short sellers forced to buy millions of shares just to stop their own bleeding.
The squeeze.
That convergence is a short squeeze. It creates a violent, explosive upward spike in the stock price.
So if you are a retail trader, you see that 12% jump, you see that massive 32% short interest, and you think, this is it. The squeeze is happening right now. I'm going to buy in at $8 and ride this rocket to $20. Why is that a trap? I've seen so many people get crushed playing this exact setup.
Because of the broader context we just established, you have to combine that 32% short interest with the 11% weekly volatility and the ongoing share dilution.
Ah, the dilution.
That is the trap. When a retail trader buys into that sudden spike at $7.94, hoping for a squeeze, they are stepping onto a battlefield where institutional short sellers are foolishly defending their positions with massive capital.
All right.
If the squeeze doesn't fully trigger, if the momentum stalls at that $9 resistance level we talked about, the buying pressure fades. But here is the lethal part. Remember that share dilution.
Yeah.
If the stock suddenly spikes to $10 during a mini squeeze, the company's management might look at that high price and decide to issue millions of new shares to raise more cash.
Oh, wow.
Suddenly, a massive new supply of shares floods the market, completely overwhelming the demand. The price collapses back down to $6 or $7, the institutions cover their shorts, and the retail trader who bought the peak at $10 is trapped holding the bag at a massive loss.
It's an emotional trade rather than a fundamental one. You are basically playing a game of chicken with institutional billions, and if the company dilutes into the spike, the retail investor is the collateral damage.
That is the reality of trading high volatility, high short interest stocks. The institutions just have a much longer timeline, sophisticated hedging strategies, and a lot more capital to weather the storm.
So, bringing all these facts together, looking out at the horizon, what should you, the listener, be watching for next? In the short term, over the next few weeks, absolutely everything hinges on May 12th, 2026.
The earnings call.
Exactly. That is the date of their next earnings report. Given the extreme 32% short interest and the high volatility we've discussed, that earnings call is going to be the ultimate catalyst.
It really is.
It will either fundamentally prove the hypergrowth narrative, highlight massive enterprise adoption of their agentic AI, and ignite a historic short squeeze, or it will highlight the ongoing cash burn, reveal more share dilution, and deliver a brutal reality check to the bulls.
And if you are looking at the medium to long-term outlook, you have to look past the day-to-day chart noise and focus on management's roadmap.
Right.
Their ultimate stated goal is achieving adjusted EBITDA break-even by the end of 2026. To pull that off, they are entirely banking on their agentic AI platform becoming the undisputed standard for enterprise voice automation in sectors like telecom and insurance.
So it's a binary outcome in many ways.
Yeah, if they fail to secure those enterprise renewals, the cash pile will eventually run out. It really feels like a make-or-break year for the company.
It really does.
To summarize the ultimate tension we are looking at today, you have a fundamentally debt-free company with exploding 99% year-over-year revenue growth. They have a war chest of nearly $250 million in cash.
But they are fighting an uphill battle.
They are fighting against their own high share dilution and massive pessimism from short sellers who simply do not believe the path to profitability is real.
It is the ultimate market standoff. So I will leave you with this final thought. If SoundHound's agentic AI really does become the voice automation standard for telecom and insurance, if their software becomes as ubiquitous as the automated phone menus we deal with today, will those short sellers be forced to cover their positions in a massive panic?
Good question.
Or will the company's continued cash burn eventually dilute the stock all the way back down to its 52-week lows? And building on that, could an unexpected acquisition by a major tech giant suddenly take this entire debate off the table before the year's out? We'll find out what the next chapter holds on May 12th. Thank you for joining us on this deep dive. Don't forget to like, subscribe, and leave a comment below telling us which side of the trade you are on. We will see you next time.